There was a time, not very long ago, when the American South felt unstoppable. From Texas to Florida, from the Carolinas to Tennessee, the region was framed as the future of American living. Cheaper land, lower taxes, warm weather, new jobs, new people, new money. And for a while, the story was true. Moving trucks rolled southbound in record numbers, license plates changed, suburbs stretched outward, cranes dotted skylines that once sat low and quiet, builders spoke confidently, city planners approved permits faster than ever, investors ran spreadsheets that all pointed in the same direction. Up and to the right. But history has a habit of repeating itself, not loudly, not all at once, but quietly, decision by decision, assumption by assumption. And today, the Southern housing market is facing a reality that few want to say out loud. It may be overbuilt. Not everywhere. Not all at once. But enough to matter. So how did this happen? To understand the surplus, we need to rewind, not just a few years, but several decades, back to the forces that shaped Southern growth long before the first foundation was poured. The long memory of Southern growth. The South has always grown differently than the rest of the country. In the post-World War II era, northern and Midwestern cities were the engines of American industry. Steel, auto manufacturing, heavy labor, dense urban housing. The South, by contrast, was land-rich and capital-poor. But that imbalance slowly flipped. By the 1970s and 1980s, manufacturing began migrating south. Labor was cheaper, regulations were lighter, land was plentiful, highways expanded, air conditioning, often overlooked in history books, made year-round Southern living viable at scale. Population followed opportunity. Florida exploded with retirees. Texas became an energy and logistics hub. Georgia and the Carolinas attracted finance, tech, and distribution centers. Suburban living wasn't a luxury in the South, it was the default. This created a deeply ingrained belief among developers and policymakers. The South will always need more homes. And for decades, that belief was correct. The psychological shift after 2008. The 2008 housing crash left scars across the country, but the South recovered faster than most regions. Why? Because land was cheap enough to restart building. Because migration resumed sooner. Because job growth returned quicker than in the Rust Belt. But the real shift after 2008 wasn't economic. It was psychological. Builders became cautious at first, projects were smaller, lending tightened, risk was measured, inventory stayed lean. Then something subtle happened. By the mid-2010s, the fear faded. Home prices climbed steadily, interest rates stayed low, demand kept rising. The Southern market didn't just recover, it outperformed. And that planted a dangerous idea. This time is different. The migration narrative takes hold. Around 2018, a new storyline began dominating headlines. Americans are fleeing high-cost states. Texas and Florida are the new economic powerhouses. The South is the last affordable region left. These weren't wrong, but they were incomplete. People were moving south, yes. Companies were relocating, yes. Remote work was loosening geographic ties, yes. But narratives have a way of flattening complexity. Investors, builders, and local governments heard the same message. More people are coming, build more homes. And they did. At scale. COVID accelerates everything. Then came 2020. The pandemic didn't create the Southern housing boom, but it poured fuel on it. Remote work became mainstream overnight. Dense urban living lost its appeal. Single-family homes with space suddenly mattered more than proximity to downtown offices. Southern metros were perfectly positioned. Austin, Dallas, Tampa, Orlando, Phoenix, Atlanta, Nashville, Charlotte. Prices surged, homes sold in days, sometimes hours. Builders watched demand spike and responded the only way they could. They built vast. The critical assumption nobody questioned. Here's the key mistake, quiet, logical, and deeply human. Builders assumed that pandemic-era demand represented a new permanent baseline. Not a spike. Not a pull forward of future buyers. Not a temporary distortion. A new normal. So they locked in land. They ordered materials. They scaled labor. They approved subdivisions that wouldn't be completed for 2 or 3 years. And by the time those homes began coming online, the world had changed again. Interest rates enter the story. In 2022, inflation forced the Federal Reserve's hand. Rates rose faster than at any time in modern housing history. What did that do? It didn't erase demand, but it reshaped it. Monthly payments doubled. Investor math stopped working. First-time buyers hesitated. Move-up buyers stayed put. And suddenly, the pace that once justified massive construction pipelines slowed. Not crashed. Slowed. That difference matters. Because housing supply doesn't stop on a dime. The pipeline problem. Here, what many people miss when they talk about overbuilding. Housing supply has a long memory. Permits approved in 2021 didn't finish in 2021. They finished in 2023, and 2024, and even 2025. By the time builders realized demand was cooling, thousands of homes were already halfway built. You can't unpour concrete. You can't unframe a subdivision. So inventory began to rise, not explosively but steadily. And in markets that rely heavily on new construction, which describes much of the South, that rise matters more than people expect. Why the South is more vulnerable than it looks. Overbuilding doesn't mean empty cities. It means too many similar homes chasing fewer qualified buyers. The South has several structural traits that amplify this risk. Large master-planned communities. Heavy reliance on single-family construction. Suburban expansion rather than infill. Investor participation during the boom years. When demand slows, these markets feel it faster. Because price competition begins at the margins. A builder offers incentives. Another cuts prices. A third pauses new starts. Momentum quietly reverses. A historical echo. This isn't the first time the South has faced this dynamic. In the late 1980s, Texas experienced a regional housing glut tied to oil price collapses. Entire subdivisions stalled. Prices stagnated for years, not months. In the mid-2000s, Florida overbuilt aggressively. When demand vanished, inventory lingered well into the next decade. History doesn't repeat exactly, but it rhymes. And the rhyme we're hearing now is subtle but unmistakable. The question that lingers. So here we are. Homes are still being built. Population is still growing, just slower. Prices haven't collapsed, but they're no longer climbing everywhere. And that raises a quiet but uncomfortable question. What happens when a growth-driven housing model meets a pause? Not a crash, not a boom, just a pause. That's where the story gets interesting. Because overbuilding isn't a headline event. It's a slow realization. And in the South, that realization has only just begun. Overbuilding rarely announces itself. There are no sirens, no sudden silence, no single moment when everyone agrees the balance has tipped. Instead, it shows up in small signals, easy to ignore on their own, impossible to ignore when seen together. A few more listings than expected. Homes sitting just a little longer. Incentives whispered, not advertised. And nowhere are these signals more concentrated than in certain southern metros. Not all southern markets are equal. The South is often discussed as a single housing market. It is. Some cities are supply constrained by geography or regulation. Others can expand outward almost endlessly. Overbuilding risk lives almost entirely in the second category. Think wide highways, flat land, vast permits. Places where growth is easy are also places where excess accumulates quietly. The boomtown pattern. There is a recognizable pattern across several southern metros. Rapid population growth, explosive job announcements, national media attention, investor inflows, aggressive construction pipelines. Austin followed it. Nashville followed it. Tampa, Phoenix, Dallas, and parts of Atlanta followed it. Each city had real demand. Each city had strong fundamentals. But fundamentals don't prevent overbuilding. They encourage it. Austin, a case study in speed. Austin didn't overbuild because demand was fake. It overbuilt because demand was fast. Tech migration accelerated, salaries rose, builders raced to meet buyers who were paying well above asking price. But Austin has two defining characteristics. Expandable land. Heavy investor participation. When rates rose, investor demand faded first, end users hesitated second. Construction, however, kept going. The result? Inventory rose faster in Austin than in many other major U.S. cities, not because people left, but because supply arrived late. That's how overbuilding usually looks at first. Florida's familiar rhythm. Florida's story is older. The state has lived through multiple housing cycles, each shaped by migration, speculation, and optimism. What's different this time is scale. South Florida remains supply-constrained, but Central Florida and parts of the Gulf Coast expanded aggressively. Entire communities were planned around assumptions that retirees, remote workers, and investors would arrive at pandemic-era pace indefinitely. They didn't. The homes still arrived. Why inventory data can mislead. Many analysts point to inventory numbers and say, this isn't overbuilding. Inventory is still below historical averages. That's technically true and strategically incomplete. Here why. Most housing data lumps together. Existing homes, new construction, rental conversions, investor-owned inventory. But overbuilding shows up first in new construction specifically. Builders don't list homes the same way homeowners do. They control packing. They delay releases. They offer incentives instead of price cuts. The excess is there, but it's managed. For now, the incentive signal. One of the clearest signs of softening supply-demand balance isn't price. It's incentives. Mortgage rate buydowns, closing cost credits, free upgrades, quiet discounts negotiated behind the scenes. These don't show up cleanly in median price data. But they matter. They tell you builders are competing, not against homeowners, but against each other. And competition among builders is a hallmark of overbuilding. Why builders don't panic first. Builders are trained not to panic. They've survived cycles before. They understand inventory risk. They'd rather slow sales than slash prices. So they do what looks rational. Pause new starts. Finish what's already underway. Protect pricing publicly. Adjust privately. This creates a strange visual illusion. From the outside, everything looks stable. From the inside, margins are shrinking. The suburban concentration risk. Overbuilding in the south isn't evenly distributed across city centers. It's concentrated on the edges. Farther suburbs, exurbs, master-planned communities miles from downtown cores. These areas rely heavily on new buyers, long commutes, car-dependent lifestyles. When affordability tightens, these buyers feel pressure first. And that's where excess supply begins to surface. A question worth asking: if demand was truly unlimited, why are builders offering incentives? Why are new listings rising faster than population growth in certain metros? Why are permit approvals slowing even as construction completes? These aren't signs of collapse. They're signs of recalibration. But recalibration always exposes excess. The silent shift in buyer psychology. Here's something data can't fully capture. Buyers are no longer afraid of missing out. During the boom, hesitation meant losing the home. Today, hesitation feels safer. That psychological shift alone changes everything. Because overbuilding doesn't require falling demand, only less urgency. And urgency has clearly faded. What this means so far: at this stage, the southern housing market isn't broken. It's unbalanced. Supply has arrived based on yesterday's assumptions. Demand has adjusted to today's reality. The gap between those two is where overbuilding lives. Quietly, gradually, unevenly. And that gap is still widening in certain places. Looking ahead, the real question is whether the South is overbuilt. The question is, how long can builders, investors, and local markets manage the excess before it shows up in prices, rents, and development decisions? That's where the story goes next. Because once overbuilding becomes visible to everyone, the behavior changes. And markets follow behavior, not headlines. Overbuilding doesn't always end with falling prices. That's one of the most misunderstood truths in housing history. Markets don't need to collapse for leverage to change hands. They don't need panic to reshape behavior. They only need time. And time is exactly what excess supply creates. The myth of the sudden drop. Many people are waiting for a moment. A headline. A sharp correction. A dramatic reversal. But most housing cycles don't work that way, especially not in growing regions like the American South. Instead of prices falling fast, something more subtle happens. They stop rising. That pause alone changes everything. Why flat prices are more powerful than falling ones. In boom periods, rising prices forgive almost every mistake. Overpay a little, prices rise. Stretch the budget, appreciation helps. Build slightly too much, demand absorbs it. But when prices flatten, forgiveness disappears. Builders feel it first. Because they rely on velocity, not just value. The slow erosion of pricing power. Overbuilding doesn't force sellers to cut prices immediately. It forces them to compete. And competition erodes power in stages. First, buyers gain time. Then they gain options. Only later do they gain leverage. That process is already underway in parts of the South. Homes that once sold in days now take weeks. Weeks become months. Months change expectations. Not dramatically, gradually. How builders adapt and why it matters. Builders rarely lead price declines. They lead terms adjustments. Mortgage rate buy-downs quietly reset affordability. Closing cost credits simulate price cuts without advertising them. Design upgrades are bundled to justify sticker prices. On paper, prices look resilient. In practice, margins are thinner. And thinner margins mean fewer future starts. This is how overbuilding corrects itself, not through collapse, but through restraint. The investor layer beneath the surface. One of the defining features of the Southern housing boom was investor participation. Not just institutional funds, but small investors. People buying single-family homes as rentals. Short-term rental owners chasing yield. Remote investors drawn by Sun Belt optimism. They didn't dominate every market, but they mattered at the margins. And margins are where overbuilding shows up first. Rental saturation, the overlooked pressure. In many southern metros, new construction wasn't just for buyers. It was for renters. Entire subdivisions were designed as build-to-rent communities. Single-family homes were underwritten as income properties. Rent growth was assumed to be steady and strong. That assumption is now being tested. As supply rises, rents stabilize. As rents stabilize, investor math tightens. As investor math tightens, demand weakens. Not everywhere, but enough to matter. When exit options narrow, investors are flexible until they are. They rely on 3 exits: appreciation, cash flow, liquidity. Overbuilding pressures all 3 at once. Prices stop climbing. Rents stop accelerating. Listings take longer to sell. That doesn't cause panic selling. It causes passivity. And passivity slows markets just as effectively as fear. Why some cities will feel this more than others. Not all southern metros are equally exposed. The most vulnerable share common traits. Rapid expansion at the outskirts. High share of new construction. Investor-heavy demand. Car-dependent affordability. These markets don't collapse, but they recalibrate harder. Meanwhile, cities with strong job diversity, constrained land, established neighborhoods, infill demand, will absorb excess faster. This is why national headlines miss the story. Overbuilding isn't regional. It's local. The human side of overbuilding. Behind every data point is a decision. A family waiting longer to list. A buyer choosing to rent 1 more year. A builder delaying the next phase. None of these feel dramatic. But together, they slow the machine. And housing is a machine built on momentum. A historical parallel worth remembering. In the early 1990s, many growing regions avoided outright crashes. Prices stagnated for years instead. Nominally stable. Inflation-adjusted declines. Lost opportunity costs. That kind of market doesn't make headlines, but it reshapes wealth quietly. Overbuilding doesn't destroy value overnight. It dilutes it over time. The shift no one talks about. The biggest change isn't inventory. It's expectations. Buyers no longer assume urgency. Sellers no longer assume bidding wars. Builders no longer assume absorption. When assumptions change, strategies follow. And when strategies change, markets change. Where this leaves the South right now. The southern housing market isn't failing. It's maturing. Years of fast growth pulled future demand forward. Supply raced to meet it. Now both are adjusting to a slower rhythm. Overbuilding isn't a verdict. It's a phase. And phases always lead somewhere. The final question before the end. So the real issue is whether the South built too much. It's this. What happens next to prices, development, and power once the excess has been fully acknowledged? That's the final chapter. Because how a market responds to overbuilding matters more than the overbuilding itself. End of part 3. When you're ready, I'll conclude with part 4, covering long-term outcomes and corrections, strategic winners and losers, what buyers, builders, and investors should understand next. Every housing cycle ends the same way. Not with a crash, not with applause, but with a reset. Overbuilding doesn't destroy a market. It tests it. And the southern housing market is now being tested, not by fear, but by reality. What overbuilding really corrects? Overbuilding doesn't correct prices first. It corrects behavior. Builders stop assuming endless demand. Investors stop assuming effortless appreciation. Buyers stop assuming tomorrow will be more expensive than today. That shift alone is powerful. Because housing isn't just a financial system, it's a confidence system. And confidence always moves before numbers do. The long, quiet absorption phase. When supply outpaces demand, markets don't collapse. They absorb. Absorption looks like this. Homes take longer to sell. Rents stabilize instead of rising. New projects get delayed, resized, or cancelled quietly. No panic. No headlines. Just patience. This phase can last years. And in growing regions like the South, it usually does. Why prices often hold, but wealth doesn't grow. Many homeowners will look at their neighborhood and say, prices haven't fallen, everything's fine. But wealth is more than price. It's opportunity cost. When prices stall while inflation continues, real value erodes quietly, not painfully, but persistently. That's the invisible cost of overbuilding. Not loss. Delay. Who adapts and who does. Every cycle creates winners and survivors. Builders with strong balance sheets slow down and wait. Smaller builders with thin margins struggle. Speculative investors exit first. End users gain leverage without realizing it. The market doesn't punish everyone equally. It rewards patience. The new power structure. Overbuilding shifts power away from speed and toward discipline. During booms, speed wins. During resets, discipline wins. Those who can wait gain optionality. Those who must sell lose leverage. This is where smart buyers quietly re-enter, not chasing peaks, but choosing moments. What this means for buyers. For buyers, overbuilding creates something rare. Joys. Time to negotiate. Time to inspect. Time to walk away. These aren't dramatic advantages, but they compound. In housing, time is leverage. What this means for sellers. For sellers, especially in newly built suburbs, expectations matter more than listing prices. The market will still clear, but not on yesterday's terms. Those who price realistically sell. Those who don't wait. And waiting is a decision, whether acknowledged or not. What this means for builders. For builders, the era of assumption is over. The next phase, rewards. Phased development. Conservative absorption models. Product differentiation. Local demand understanding. The builders who survive don't build less. They build smarter. The Southern advantage still exists. It's important to say this clearly. The South isn't declining. Jobs are still coming. People are still moving. Businesses are still relocating. Overbuilding doesn't erase fundamentals. It disciplines them. A historical pattern repeating calmly. History shows that the healthiest markets are not the ones that grow fastest, but the ones that pause when necessary. The South is pausing, and pauses are how long-term stability is preserved. The final perspective. Overbuilding isn't a warning sign of failure. It's a sign that optimism ran ahead of reality and is now being corrected. Quietly, gradually, humanely. This is how strong markets mature. Not by breaking, but by learning. The last question to leave with. So when people ask, is the Southern housing market in trouble? The more accurate answer is this. It's no longer being carried by momentum. It's being tested by discipline. And discipline, in the long run, builds stronger foundations than speed ever could.